Hey everybody, good to be with you today. It's Friday, advanced options. Glad to, always good to see some familiar names in the chat, and if you're watching on a recording, we're glad to have you here too. I thought I'd hit up a topic that I haven't covered for a long time actually, and so I'm glad to cover that with you, and that's straddle strangle swaps. So I want to talk about that today. We sometimes we'll do them without even kind of talking about that name. They're really kind of a double diagonal spread, but you'll see what I mean as we talk about these. I think they're a good strategy to learn with and to paper trade. And that's what I encourage you to do, is to paper trade and try out these different strategies that we use. I'm joined today, Kevin Horner, helping me on the chat. Appreciate Kevin always. Kevin's a longtime market veteran, and I've learned a lot from Kevin over the last couple of years that we've been working together fairly closely. So I'd also encourage you to check out the Trader Talks webcast we have Mondays, Wednesdays, Thursdays, Fridays at 9:30 Eastern time. Kevin is the main host of that, and you'll learn a lot. I can guarantee that. You can follow either of us on X at Brentmore CS, at Kevin Horner CS. Now, before we get too far into it, let me just mention a few things. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It is not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money application is provided for educational purposes only. And I may not factor in commissions or fees in these trades that we look at today, but just realize they are a real thing to consider. All investing involves risk, including the potential risk of loss. And let's see, stop orders. There's no guarantee of an execution of a stop order that it's going to be at or near the stop price. All right, so, and short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and that is particularly pertinent today because we will be dealing with short options. And so, so there we go. Let's get to it. Let's bring up the Thinkorswim platform. This is the markets today. We had kind of a bummer jobs report this morning, just to kind of kick us off and give you the context. Initially, the market responded well in what seemed to be kind of one of those bad news is good news moments. What do I mean by that? What I mean by that is the bad news of a poor jobs report seems to give the Fed, free rein, so to speak, more reason to cut interest rates. So the market seemed to react initially kind of positively like that, but and at this point it just seems like bad news is bad news, and and the market is selling off here. So anywho, that's where we are. We hit I guess looking at this, I didn't even realize this, we hit an all-time high earlier today on the SPX, but we're off that. We're off that now, right on that 20-day moving average. Okay, let's move ahead. Let's look at the straddle strangle swap. Let's talk about that, and then I want to give you some example trades on that. But just for definitions, when we talk about a long straddle, we are talking about buying a call and buying a put, same strike price, same expiration date. Okay, a short straddle would be selling a call and selling a put, same strike price, same expiration date. Okay, long we're buying, short we're selling. Okay, fair enough. A strangle, we're just not using the same strike prices, same definitions. In the case of a straddle strangle swap, what we're going to be doing is we're going to combine a short straddle or strangle with a long straddle or strangle. You can do it either way, folks. Doesn't matter. You see them demonstrated online. You'll see them demonstrated both ways, to be very honest, okay? So, but what we are going to do is we're going to sell near-term expirations, and we're going to buy longer dated expirations. All right, so that's going to give us some advantages, which we're going to talk about that in just a sec. But in general, the way we're going to target these, they're going to be more of a neutral forecast. Now, as with a lot of these trades, when we talk about iron condors or calendars or butterflies, I often, will say, well, they're kind of neutral, but depending on what strikes we pick, they may kind of lean a little bit more bullish or lean a little bit more bearish. But I think when we talk about these, for the most part, we're going to consider these to be more of a neutral-ish forecast. Should I put ish on the neutral to kind of emphasize that it's not exactly neutral? And we'll see that as that goes forward. By selling the near term, contracts and buying the longer term contracts, because time decay is higher, is more rapid on the near term, that means there's going to be theta positive trades. Okay, positive. They're theta positive, and they are going to be vega positive. Okay. Now, one of the things is this. When I say vega positive, really the biggest thing that a lot of traders will look for on these is they'll look for a volatility dispersion. Do you guys know what I mean by volatility dispersion? What I mean is a difference in volatility between these near-term contracts and the longer-term contracts. And often we'll see that on, say, for example, when earnings come out. You see the near-term contracts will have a high IV. So if you have a high IV, I'll abbreviate HIV, high IV, okay? And then the longer ones are a lower IV, okay? What happens is, let's say an earnings event comes out and that IV drops, the high IV is likely going to drop a lot. Okay, I'll put a little plus sign, double plus, a lot, big drop. The lower IV still may drop on earnings, but it's less likely it's going to drop less. Okay, so that's what I'm calling about this, and we call that volatility crush, and that can benefit you on this trade. Okay, so I want to give you an example of an earnings trade where we can look at that, and that can benefit you. But really, as with a lot of these, really what we want is that forecast to be right where we are. Now, specifically, what contracts are we going to buy? Look, different people can choose different strikes, different expiration dates here. But in general, just to kind of give you a starting point, we'll say, a starting point for your paper trade, your short options, I'm going to say 20 to 40 days till expiration, okay? And I'm going to put just a little caveat next to that, unless earnings affects that, okay? All right. And for your long options, I'm going to say, well, we're going to buy at least 2 weeks after that, okay? So that's kind of how we're going to target in terms of what expiration dates we're going to have. Okay. For the strangle portion of this, for strangle, and if you're wondering what strikes we're looking at, and you can play with this, we're going to say strikes near. Now, one is going to be out of the money, one's going to be in the money, right? Because we're doing a strangle here. So I'm going to say 30 to say 40 delta, and near 60 to 70 delta. Now, remember that delta measures how much that stock, how much the option is going to move in relationship to a $1 move in the stock price. But as a secondary means, it can kind of give us an idea of just how far in the money or out of the money the contracts are, which is the purpose we're using them for now, just to get them a little bit in the money, a little bit out of the money, but not ridiculously far in the money and ridiculously far out of the money. And then once you put those in, then you can kind of tweak them and play with them a little bit there. And for the straddle, we're going to go at the money. Those are the strikes we're going to do. I just have a few more of these. We're going to exit or roll. And remember, rolling entails multiple commissions at, I'm going to say 25 to 50% max gain. It's very difficult to achieve your max gain on these. Okay, so we're not gonna even like plan on getting that max gain. We're gonna exit that trade before we ever get to that max gain. We're also gonna exit on a technical break down in the stock. And so if this is kind of a neutral trade and we're planning something more neutral, that breakdown could be either, when I say breakdown, that may kind of imply you may infer from that means it's going down. But if the stock goes up a lot, that's a technical breakdown of the trade. There is how I would say that, okay? So we're going to exit there. And then we're going to get out, exit less than 10 days till expiration. We'll just look to get out. And let me just see if do I have any other things? Yeah, for money management, this will be our last one. 1 to 2% of active trading portfolio risk. Okay, so there's our basic rules there. That's what we're going to start with. We're going to give you an example, a couple examples probably of this. But for some of you, like just kind of the nuts and bolts listed out. So I wanted to start with that. If you'd like, you can always take a screenshot of this or write them down or whatever you want. If you're watching on recording, you can pause it, whatever. But I'm going to move on from this. We may revisit this list a little bit later, but I want to give you some examples here. And one of the examples I wanted to give you as we look at this is I was going to consider earnings. What companies have earnings coming up in the next week? Oracle's coming up with earnings. That's one. Chewy is I'm just kind of picking some, obviously there's a lot of companies coming out with earnings, but I wanted to pick some that you were probably familiar with. And another one you may be familiar with is Adobe. Okay, so here's Adobe. This is the one I'm going to kind of target here. We can see we've got earnings coming out next week on this, on the 11th. Adobe has been a company that has kind of the narrative lately, and I'm not an Adobe expert by any means, but the narrative lately has been Adobe is struggling with some of its competition because of AI, okay? They haven't maybe adapted as well to our new AI world in terms of there's a lot of things that AI can do that is maybe replacing what people really needed Adobe to do, Adobe products to do before. And so that's kind of the narrative that at least I've heard on this. And so you can see Adobe struggled a little bit here. That's a 6-month chart. Let me go a little longer. Here's a 9-month chart. You can see we were up at 557. We're now down to 346. That was 9 months ago. Okay. By the way, there's a survey link in the chat. We always appreciate your feedback. And so if you, I always look for topic suggestions too. And this, I can't guarantee I'm going to cover every topic, but I generally do my best to try and cover topics that you suggest too in there. So we do appreciate your feedback here. But let's continue on with Adobe. Now, here's the thing. Remember before I said this is going to be more of a neutral-ish type trade. And so if I think this is likely to move a really long ways up or down, I may not do this. And Chris says, hey, it often makes big moves on earnings. Well, here was an earnings back here. Big kind of gap down, big gap down. Doesn't mean it's always going to gap down. In fact, this one gapped down too. I wouldn't bet on it necessarily gapping down on earnings. Maybe it does, maybe it doesn't, but just because we've had some, it doesn't mean it's going to in the future. But at a certain point on some of these stocks that have really been beaten up, you kind of think, a lot of times we may think, well, it's come to maybe a more reasonable valuation. Doesn't mean it can't go down further. Maybe some of the expectations from earnings are a little bit diminished. So maybe the potential for the gap may be a little bit less. You can always look at like the at the money straddle here to just kind of see what we're looking at here. What stocks at 347? We'll call that good. About a $32 move is predicted on earnings. Okay, so so you can do that. Now, questions you may have: is this going to hold as a support level? I don't know. Earnings can certainly change things on this. $32 plus or minus gives us about a, let's see if I can do my math right here on that, about a 315 low end kind of. This would be kind of the market, what the market's pricing in for the move down there. And then 32 plus that is going to be about 380 on the high end. Roughly there is kind of how the market is pricing that in terms of the move here. So we're going to look at a more of a neutral trade. So let's go through, and this is what I'm going to do. I'm going to do a short straddle and a long strangle. Now we can mix though, you can mix and match if you want here, okay? But I'm going to do a short straddle. That's going to give me two strikes that are at the money. That's going to presumably have the most time decay on those contracts, which is the time decay that helps us on the short contracts. Now, furthermore, I'm going to go out and I'll go out past earnings. So I'm going to go to September 19th here. I'm going to go to the monthly options, September 19th. Let me get out. I have straddle here. I can leave it at straddle. You can also do them as individual contracts. The stock right now is at 347. So I'm going to go to 347 and I'm going to sell the straddle here on that. That's the first thing I'm going to do. Okay. Now, what am I going to do now? I'm going to go and I'm going to go out. Remember, we want to go out at least a couple weeks more. I'll go out to the monthly contracts. So I don't have to go all the way. I can go out a little further. I'm going to stick with monthly contracts on this one. And let me go to individual. Let me go to strangle here. And I'm going to hold down my control key while I do this so I don't overwrite the previous one. And we said 347.50. Let me go to 340. And I'm going to just hold down my control key. And that's going to add that in, 340. And I'm going to go, let's see, that actually, I want this to be a higher strike. Let's go to 355 and 340. And let's just kind of summarize where we're at here. Just kind of show you where we're at on this. So I'm selling two front expiration contracts at the 347 level. I'm buying on October 17th, out longer, a 355 call, and on October 17th, a 340 put. The net debit is not a lot right now. It's about 18 cents here, okay? Times the 100 multiplier on that for a contract. And we're just going to look at one contract right now on this. Now, so what I'm going to do here is this. I'm going to look at this from our, on our analyze. We're going to analyze this trade. We go to risk profile. Let me go down here and let's see, where did September 19th, September 20th, that works. I'm going to set my slices here to break even on the chart. And you can see this is a higher probability trade. But of course, so you have this big wide movement, but the stock is likely going to move quite a bit on earnings. Okay. So let's look at this, and then Rich, you got a question, so we'll look at that as well. Okay. So 309 and 399 is our expiry, is 309 and 399. So our break even is actually about there and about here on this trade. So that worked out pretty well. Now, Rich said, what about delta on this? Okay, so let me go back and just double check our delta on this and see what we got. We did, I forgot our strikes. We said the 340 and the 355. Okay, so 355 actually is a delta which is going about to the 49. So you're right. It isn't actually at the 60, excuse me, the 30-ish delta, which is kind of where I was looking at before on that. But this is actually about a 50 delta, which is interesting because this is actually out of the money a little ways here in terms of our strike. So yes, I didn't, Rich kind of called me out because I said, well, kind of in our general guidelines here, I said, if you want some help on finding that, you can look at near this like 30 to 40 delta range. Well, I didn't even do that. I wanted just a gap here because the reason why is what I want to do is I then want to just kind of tweak the strikes a little bit on this page and then just see how that affects it. Then we're going to decide that. Okay. So good point. My general guidelines, I tweaked them a little bit here on this there in terms of this, because I want to just kind of look and see what strikes we're going to look at. So here is our break even. Okay. And what I want to do is I do want these hopefully break evens to get outside of our market maker move. Yes, that's one of the goals here. But we're also going to consider, here's our max gain. Our max gain on this trade is showing as $2,700 basically. But remember, that is probably not a super likely scenario that we're going to get up that far. So we'll have an exit that is a quarter to a half that level on that. We'll put that in. Also, what we can do, you can always tweak this a little bit. And you can say, well, I'm going to go out and I want to change my strikes a little bit. So let's go out, instead of the 355 and 340, let's do a 360 and a 335. And let me set my slices to break even again and see how that changed. It changed it just a little bit, not a lot. The numbers didn't change that much. And to be honest, that's been my experience on a lot of these is you can tweak the numbers. They don't radically change if you just change them by a strike or two, okay? Our break evens are still outside of our market maker move, our expected move on that trade there. Now, let's look at our Greeks. Let me add a strike. Here's a price slice. Delta, that's pretty small. It's mostly neutral. Okay, that's a very small delta. Theta is significantly positive. We have a fairly significant time decay on that. Our implied volatility, our vega is 36. So that is going to, in one sense, that is going to work against us for our IV, when IVs drop, assuming IVs drop on earnings. But here's what I want you to consider as well. Look at the IVs on the individual strikes here. Let me just move this up just a little bit so we can see this a little bit better. So here's your implied volatilities. So it's not going to let me change the column width. Here's your implied volatilities. I guess you can see it well enough. On my short strikes, these are the ones that are expiring soon. Check out those implied volatilities, around 65% on those, okay? On the long strikes, my implied volatilities are around 45%, okay? So that's one of the nice things on this is we do have that potential for the IV crush to disproportionately affect those. So even though I have a positive vega here, which doesn't sound great after, given that implied volatilities are likely going to drop with earnings, then that's what we got here, okay? All right. So let me go. This should be, are these not showing? These should show 310 on the strike and 397. These are our break evens right here, okay? These are our break evens. These aren't the strike prices, okay? You could do strike prices as well if you wanted, but Mahindra, I was not intending to do. You could put in your strikes right there, but that's not my goal. My strikes are actually the break-even points, is where those are. But for our purposes right now, I want to look at the current price, which is this one. This is our current price right now, and that's the one we're looking at there. Okay, all right. So I wouldn't fret so much about having vega in light of the earnings drop, given the IV crush we may have. Now, something I need to mention is this. I have two short contracts here. Remember, at the beginning of every session we do options, we always say, Kevin says it, I say it, others say it, short options can be assigned at any time before expiration, regardless of the in-the-money amount. And they become more likely to get assigned early if they're in the money. Well, both of these, we have one call and one put. Pretty much one of two of these is going to be in the money at any given time. That is one reason when we're about a week to go to expiration, I think I said less than 10 days to expiration, okay, about a week to go to expiration, we're going to look to exit these because the odds of early assignment increase. Number one, the more in the money the contract is, and number two, the closer you get to expiration. And so we're going to do it for that. We just need to be cognizant of that as we trade there. Okay. All right. I'm hoping that is making sense. Okay. Paul said, why isn't this 36 vega? So this could certainly work against us if implied volatilities drop, but the implied volatility drop actually helps these contracts right here, everybody. These are short contracts. We want these to go down in value, number one. And number two, they're likely to drop more in implied volatility than these contracts, okay? So there's going to be kind of an offsetting between the long contracts and the short contracts. That's why it may not be as bad as you may go, well, implied volatility is going to drop. That's really going to hurt our trade a lot. It may not affect us that much for that very reason, okay? So one of the risks of this trade are early assignment of our short contracts. And then obviously a big move, a bigger than normal move, a bigger than expected move would certainly hurt our trade significantly as well. And so if you scroll through and the further this goes, the more you can see, hey, there's odds that it will hurt us significantly if we go way up or way down. Okay. So this, according to our model here, and the model isn't perfect, right? This is just looking at statistics. We don't know what the stock's going to do, but this would be a higher probability trade from this. However, things can change, and as implied volatilities change and as earnings change and the market changes, things can change a little bit. But this would be deemed to be a little bit of a higher probability trade. Now, let's look at this. We said our max gain on this is about $2,700. And I'm going to look to exit here at about, well, we said 1/4 to 1/2 of max gain. I'm going to split the difference. I'm going to say 35% of max gain. So I'm going to go 0.35 times 2,700, and I'm going to look to exit at a $945 profit on this. $945 profit on that. Okay? So that's that. Now let me just double check. I know I tweaked this a little bit, and I went to, which is a little different than the trade we initially set up. We went to 335 and 360, which was pretty similar to the 340, 355, I think. 360, 335. Let me just go to our original trade. 363, yeah. So let me just make this so that this represents the trade we did on that. Okay. Let me look here real quick. Okay, we're buying this double diagonal. Okay. And there we go. Now this is looking, this is kind of strange here. Let me just do this real quick. One quick sec, and I'm going to address your question there. That's long, that's long, that's long. And 347.50. I just want to make sure I get the same strike. And I want to show you another way to do this. Okay. Worst case scenario is what Chris says. Both shorts assigned and both longs exercised. Now, remember, you control the exercise of your long contracts. Now, if they go in the money expiration and you have no other instructions on it, it will be auto exercised on that. But your long contracts, which are in this case are the 360 and the 335, okay? We control the exercise on those, okay? And we're going to minimize the odds of the short assignment. But let's say you do get assigned on the short contracts. You still have the long contracts there. So let's say you get assigned the put, okay, the short put. What does that obligate you? Well, it means you're going to be buying stock, okay? You're going to be buying a lot of stock. And this is going to be that's a lot of stock, 100 shares of stock. So you bought the stock, and then the stock goes way down. Well, you still have a long put here to try and help protect you in that case as well. So it's not, so there are some protections in there, but that is a risk that you just need to be aware of. And that's why we're going to look to get out ahead of time. What we don't want to see is a huge movement on this. And so we're going to put in some exits to try and get us out if it does move hugely, because the more it moves, the bigger the chance of that early assignment on that. Okay. So let me do this. You could also do this as a double diagonal straddle, strangle, swap. Okay, click on it right there. Now it doesn't know what strike prices or expiration dates you want here. So you got to kind of pick them out here. So we were going to do the September 19th contract, and I'm just going to click on this, and we were going to do the 347 And I'm going to just click on that. And then you got to tweak it a little bit. We said September 19th, and this one I'm going to switch to October 17th. See, so if you do it that way, you just got to tweak it right here. And you just got to double check the strikes here on this. We're selling the 347.50, and then we said we were going to do 360 and the 335. 360, and this is going to be 335. So that's the alternative way to do this trade here on this, okay? Now, let me click on confirm send. We're going to put in an exit order in just a sec, but let me just pull this up here. Okay, so it's initially starting as a credit, okay? And we have our double diagonal showing right there. So just make sure you read through that. Buying power effect, $2,100 on that, okay? Let me edit this trade. If you want to put an exit order here on this, you can click on first triggers, sequential order. I'm going to right click on this. I'm going to create an opposite order to get out. Now, where are we going to get out? Number one, we can get out based on profit or loss. Number two, we can also get out if we break through certain levels. We could say, look, I'm going to consider this to be a support level, so I'm going to look to get out if we break below that support level. I'll give it a little wiggle room. It's right now about 330, 331 is about that where I quickly drew that line there. But let's say if we go down below, say 320, if we hit down here, we're going to exit at 320, okay? What about up here? Well, let's say if we break, I'm going to say that as a kind of a resistance level, right around where our strike is, about 380. So what I could do is I could put an exit based on that too, okay? So how do you do that? You can click on a gear, click on symbol. If Adobe marks less than or equal to 320, let me try that again. Get my number lock on that keypad, I think. 320, or if Adobe marks greater than or equal to 380. That's going to get us out there, okay? And we're going to click Enter, Save. So, the question from somebody mentioned earnings coming out. Yeah, that's the whole reason we targeted this stock specifically, Sam, was because of earnings. Okay, you may have missed the very beginning of the session. We intentionally did this because of earnings, because it created that volatility dispersion that we mentioned there on that. Okay, so there we go. So that's this trade, and this is going to be a market good till canceled order on that. And that would get us out if the stock goes up too far or down too far, okay? Let's see, let me just see if there's any other questions here. Ivy should drop. Do you only need to buy? Yeah, yeah, but consider now. And here's the other thing I would say on this. Remember that this is an option. You need to be approved for options, number one, and you need to be approved for a short. You have to be approved for a short straddle on this, which is going to take a higher level options approval. So a lot of you probably won't be approved for this trade, just being real here on this. Do it in your paper money. It can be, I think, a good learning experience for you as well, even if you can't do it in your real account. And someday, maybe it is something that is of interest to you. But this is really a double diagonal trade here. Now, I'm running out of time, so I wanted to get to one more. So let's just look at one other trade that does not have earnings. This is one I'm not going to intentionally target earnings on. I'm going to look at Coinbase. here's Coinbase. Here's a stock that I'm considering to be more of more neutral. Okay, so it went up, it went down, kind of trendless right now on this. R1 said, what would the losses be if the stops are hit? You could go back and look. We don't know exactly what the losses are going to be if the stops are hit. Okay, we don't know. We just never know what those losses are going to be. You can look back on that Analyze tab, though, right? When we were on the Analyze tab, and when we were looking at Adobe, you can go right here. And of course, it depends on what day they're hit on, too. And you can look at those, and you can kind of see on that particular day, you'd be looking at the purple line there to see what the losses would be there for each of those. I don't have time to do that right now, but that's the easiest way to probably check on that, okay? So let's go back to Coinbase. I'm going to go to single here and just show you another way to potentially enter the trade. Okay, we showed you different ways. You can use just single contracts here. And I'm going to go, you don't have to do monthly contracts. You can go to weekly contracts. Here's October 3rd, about 28 days out. And remember, I said you can swap your straddle and your strangle. You can do it either way. So I can sell a 320 call, click on the bid price, sell that call. I can buy, and that one is a 36 delta there. I can buy sell a 280 put, which is about a 29 delta on this. And I can sell that one. That's our short strangle. Notice in this case, the near dated one, we're doing the strangle on. And for the straddle, I'm going to go to October 24th. We'll go to weeklies again, October 24th. And I'm going to go kind of right at the money. We'll go to 300, was right at the money. And I'm going to buy. I'm going to hold down my control key. And I'm going to buy on the put side. There we go. So we didn't enter this as a straddle, strangle, swap, or double diagonal or anything. We just did individual, just hold down my control key, and I entered those that way. Let me analyze this trade. Let's take a look. This is what it looks like. If I want to shift my strikes on this, I can do this. If I want to make this more bullish, I can just move my strikes up. You can shift them to 330 and 270, okay? Or vice versa, if I want to shift those there, okay? Rich said, so the best IV drop on earnings is a straddle or a butterfly or iron condor. Okay, let's take aside volatility skews or dispersions, put that to the side for a sec. Generally, iron condors are going to have a negative vega. Iron condors have a negative vega, so they benefit just on the pure implied volatility drop there. That is opposed to like a butterfly spread, which is a positive vega. So volatility dispersion aside, the iron condor is going to be best from that standpoint. Of course, it's more subject to a big move in the stock price here. So here's this trade. As you're looking at these, tweak the strike prices, see what you got there on this. This is, let's see, October. Let me go to October 4th, and let's just look at our break evens on this. Set slices, break even. There we go. So this one's slightly higher probability. We're not going to have the implied volatility effects we wouldn't expect because earnings isn't a factor on this one before the trade like it was on that Adobe trade on this. So, 52% benefits there, benefits if we're kind of there. Anywhere in the middle, break evens at 340 and 268. Let's just look at that on our chart. 340 and 268. 340 is roughly there. 268 is roughly there. Do you think the stock's going to stay in that range? If you don't, then you would not do this trade. Okay. If you do, then maybe you would consider the trade perhaps. Okay. So we don't have to deal with earnings on this. Probably not factoring in much of an implied volatility change on this. And there you go. I'm just about out of time, folks. Just a reminder, these are kind of starting suggestions, maybe. I don't know if suggestions is the word. A starting place for you to get started as you're looking at these trades. Practice some. If you want to do one on earnings, Oracle has earnings next week. Do a practice trade on Oracle or do a practice trade on Chewy. They have earnings. If you don't want to do earnings, there's a lot of stocks out there that don't have earnings because we still have a little ways to go before we hit earnings season. So check those out as well. I want to thank you for joining me today. We have that survey link in the chat. Thank you, Kevin, for helping me out in the chat. And everyone, we got market movers coming up at the top of the hour. Have a wonderful weekend. That's Straddle Strangle Swaps, everybody. And we'll see you same time next week. Bye-bye.